Dan Lacalle is with us, Chief Economist for Tressis Gestion. Happy New Year.
Happy New Year to you too.
Thanks so much for coming in. Let's just pick up on this Chinese inflation data. What do you think it tells us?
It tells us that the slowdown of the Chinese economy is much bigger than what we initially expected last year. We have seen industrial production, consumer confidence. We have seen many different leading indicators showing to this point. And obviously, another factor that it's showing is that the yuan devaluation has hurt the economy more than what consensus expected. Actually expected that the yuan would have helped the economy. It's actually done the opposite.
So great, rub your hands.
Exactly.
The Chinese government is going to step in with huge liquidity injections.
Absolutely.
Or,
as always.
Or aren't they?
Absolutely they will.
I mean, they are trying at this point to deleverage, over-leverage parts of the state-connected industries.
Yeah.
So why would they want to reliquify and provide easy credit to the economy when that's going to go into the wrong pockets?
Well, you see, these are the contradictory messages that we always get from China. On one side, you hear that the government is committed to deleveraging. On the other side, you have massive liquidity injections, rate cuts, yuan devaluation. An economy that is growing at 6.5% with 3% unemployment, with 3%, with very low inflation, is not an economy in which you inject trillions of yuan and need a devaluation and rate cuts. So no, the Chinese economy cannot grow and deleverage at the same time. It needs 4 times more debt today to create a unit of GDP than 10 years ago. So the government needs to choose. The government needs to choose between sustainable growth, which is closer to 4%, not 6.5%, rather than...
You've answered my question. Actually, but I'm going to ask it anyway. Where is the sustainable level of growth? Because there seems to be a panic every time we see a lower bit of fixed asset investment in China, when we see lower spending in China, the inflation data, etc., etc. Across the board, the data is weaker. But by Western standards, by developed market standards, they are all pretty much great figures in many cases.
Exactly.
So we're now at between 6.5 and 7 on the overall GDP figure on the official statistics. We have official statistics in inverted commas on a lot of countries. I'm not picking on the Chinese here as well. But as they become a developed nation, and they are a developed nation in many, many ways as well, 6 handle is unsustainable, isn't it? But then people start talking to me about the social consequences and the problems there on the contract with the people from the government if we get below 6. So between 4 and 6, are we in a very torrid area? Does that become a non-soft landing?
Well, that is the problem, is that the Chinese economy, 4% growth for the Chinese economy is the equivalent of recession for the OECD economies. Why? Because there's so much overcapacity that has been built in the last 10 years, so much debt that requires this sort of running to standstill strategy of getting more debt in order to sustain businesses that are underperforming. And that makes it very, very difficult for the economy to go back to normalized levels of growth and at the same time improve its productivity and its leverage. So, but the sustainable level, this is the Chinese government needs to understand this, is that the sustainable level is much closer to 4, and that soldiering on with the idea that the economy needs to grow at 6.5% is going to create further damages and more intense ones in the future.
They only have to look to 1997 to see the evidence, don't they?
Exactly, absolutely.
Can I take you to the stock market? We are trading around 2014 levels on the Shanghai Composite. It's been quite an extraordinary pullback from the highs that we had on this index right back in 2015, the real height that you saw, that big spike like a mountain. But since then, we've come right back to fairly low 2014 handles. How do you trade China? Because clearly there's still pockets of wealth. There is a growth story still around some areas, whether it's luxury or consumption. There was a story this week from the ministry saying they want to encourage more purchases of household goods, including cars. So would you trade it via China, or would you be looking at China proxies, whether it's through a luxury European company or through an American international company if trade gets resolved?
Yeah, the Shanghai Composite is the index that is always cheap. And it is an index that always looks optically cheap, just a little bit like Russia, to be fairly honest. Why? Because the biggest components of the Shanghai Composite don't generate returns above their cost of capital and never do, even with all the consensus estimates. Therefore, the best way to trade the improvement in the new economy in China, the best way to trade the things that are actually improving, and many of them are, is via luxury goods companies. Australia obviously is a key way of investing into the Chinese growth without the Chinese risk, and basically try to avoid the state-owned enterprises, try to avoid the very large conglomerates. That's you know, it's not an easy index to trade from a long-only perspective. Because, as I said, it looks always cheap, but it's cheap for a reason.